There's a popular saying that goes, "Nothing in this life is certain except death and taxes." And today, we're venturing on an enlightening expedition into the realm of tax incentives and savings in South Africa. We'll endeavor to untangle the complicated web of tax converting complex ideas into digestible terms. As we navigate through each tax incentive, we'll illustrate how you can exploit them to your benefit, whilst delving into tax-saving schemes that could amplify your income and minimize your tax liability. This exhaustive guide's purpose is to furnish you with the knowledge and resources necessary decisions about your tax planning. So whether you're a seasoned investor, an ambitious professional, or just embarking on your financial voyage, there's valuable insight for everyone. Remember, knowledge isn't power until it's applied. The more you comprehend about taxes, the more astute decisions you can make to and shield your wealth. Don't miss out on staying updated with the latest in tax planning and savings. Subscribe. In the subsequent scenes, we will elucidate the critical distinction between tax evasion and tax avoidance. So strap in, and let's get this journey underway. Welcome to our comprehensive guide on tax planning in South Africa. But before we dive into the nitty-gritty of maximizing your income and minimizing your tax liability, it's crucial to understand the difference between tax evasion and tax avoidance. Tax evasion and tax avoidance might sound similar, but they represent two fundamentally different concepts. Tax evasion is illegal. It involves deliberately misrepresenting or concealing the true state of their affairs to the tax authorities to reduce their tax liability. This could include dishonest tax reporting, such as underreporting income, inflating deductions, or hiding money and its source. On the other hand, tax avoidance is perfectly legal. It involves arranging one's financial affairs to minimize tax liability within the law. This could include making strategic investments or claiming legitimate deductions and credits, all within the bounds of the law. Understanding this distinction is crucial because while the goal of tax planning is to minimize your tax liability, it should always be done within the confines of the law. Our goal with this series is to help you understand how to do just that. In the next scene, we'll start diving into the importance of tax planning. So let's get started. Ever pondered on navigating the intricate maze of tax laws in South Africa? Or perhaps you're just on a quest to capitalize on your income and preserve a chunk more of your sweat-earned capital. Either way, a comprehensive understanding of how to legally shrink your tax liability is a critical expertise. One of the key incentives is the Small Business Corporation Tax Incentive, which aims to support local SMEs in South Africa by offering a tax rate. This incentive can significantly bolster your bottom line, but it's essential to meet the qualifying criteria. Another attractive proposition is the Research and Development Tax Incentive, which allows businesses to deduct 150% of their expenditure on R&D activities from their taxable income. This scheme is designed to foster innovation and technological progression, providing a crucial boost to businesses in the tech sector. For individual taxpayers, the deductions available for retirement fund contributions can be a boon. The South African Revenue Service, SARS, allows taxpayers to deduct up to 27.5% of their taxable income if it's invested in approved retirement funds. This incentive not only aids in wealth creation for one's golden years, but also offers considerable tax savings. In addition to these, there are a plethora of other incentives like employment tax incentive, tax breaks for investing in venture capital companies, Section 12J, and more. Understanding these incentives and how to leverage them can significantly trim your tax bill legally. First, think about maximizing your contributions to your retirement fund. When you invest in retirement annuity funds, your money grows tax-free until you retire. Start withdrawing it. This can significantly boost your retirement savings. Putting money into employer pension or provident funds is another smart move. These employer-sponsored plans often come with matching contributions, which can further increase your savings. Not only are you ensuring a comfortable lifestyle in your golden years, but you're also minimizing your taxable income. It's double win. You're saving for a brighter future while reaping the reward of tax incentives in the present. These tax benefits could include reduced tax liability and potentially a higher tax refund, boosting your financial health both now and in the future. Next, we'll discuss the benefits of a tax-free savings account. This account is a savvy tool designed to let your investments flourish without the added burden of taxes. Picture it as a protective force field around your savings. Let's delve deeper into each incentive this account offers. Firstly, it shields your savings from tax on interest. Essentially, the interest you earn from your investments is not taxed, allowing this amount to compound and grow over time. Secondly, it provides a barrier against taxes on dividends. If you own shares in a company that pays dividends, the revenue you from these dividends will not be subject to taxation in this account setup. And lastly, it protects you from capital gains tax. When you sell an investment for more than you purchased it for, that profit is known as a capital gain. Typically, these gains are taxable, but with a tax-free savings account, your capital gains aren't touched by the taxman, bolstering your overall investment growth. So a tax-free savings account isn't just a simple tool. It's a profit-maximizing armor designed to shield your hard-earned savings. Moreover, let's not ignore the medical scheme fees tax credits, a significant tax incentive. This system provides tax relief to taxpayers who contribute to medical aid schemes, effectively allowing them to decrease the tax they owe. It works by taking into account the number of dependents you have on your medical aid scheme. The more dependents, the higher the tax credit, which can result in substantial savings. So, not only does this incentive make medical aid contributions a bit easier to handle, but it also supports families, making healthcare more accessible and affordable. Now, if you're a work-from-home professional, dwelling in an untapped gold mine of deductible expenses is your daily reality. Rent, for instance, could be partially deductible if you're using a portion of your home exclusively for business purposes. Interest on your mortgage, too, isn't left out, as it could be claimed as home office deduction proportional to the part of your home used for work. And that's not all. Electricity costs, often overlooked, can save you a pretty penny, as they could be deducted in proportion to the percentage of your home space used for business. Lastly, data expenses, an indispensable component of remote work, can also potentially mitigate your taxable income if you can clearly demonstrate the business usage of your internet connection. However, do remember that all these deductions are subject to certain conditions being met, which is why it's crucial to keep a meticulous record of your expenses. Let's delve deeper into the world of professional body membership and subscription fees. These fees, which are often necessary for certain professions, with examples ranging from the legal sphere to healthcare, can add up to a significant sum over the course of a year. But here's the good news. They could also serve as your golden ticket to additional tax deductions. How does this work, you might ask? Well, these costs can be written off as business expenses, providing a way to reduce your taxable income. Hence, you'll owe less in taxes at the end of the year. This gives you a financial incentive to stay plugged into your professional community while simultaneously reducing your tax liabilities. For those with investment income, claiming allowable tax deductions for capital gains and interest income can become a game changer. Capital gains tax deductions are applicable when you sell an investment or real estate for a profit. By understanding the holding periods and tax rates, you can strategically plan your sale to maximize the deductions. On the other hand, interest income tax deductions can be claimed on interest expenses against your investment income. It's essential to be aware of the specific expenses that qualify for this deduction. It's all about understanding your thresholds, discerning the nuances of each tax incentive, and structuring your asset sales accordingly. Education and training linked to your profession present deductible opportunities under concrete conditions. For example, certain professional development courses or trade certifications may be eligible for deductions, aligning with the golden trio of the IRS's criteria: ordinary, necessary, and reasonable. Not to mention, these deductions can potentially lower your taxable income, thereby reducing the overall amount of tax you owe. Investing in self-education isn't just an investment in your personal growth and career advancement, but it could also be a tax-efficient move. With self-education expenses, you may be able to claim a deduction for course fees, textbooks, stationery, student union fees, and even the depreciation of your laptop. Remember, the key is that these expenses must be directly related to your current income-earning activities. So, not only do these avenues contribute to sharpening your skills and staying at the forefront of your industry, but they also come along with the added allure of potential tax incentives. Finally, structured saving for children's education through education policies or savings accounts can offer tax-efficient saving mechanisms and long-term financial benefits. To elaborate, education policies usually offer tax deductions on the premiums paid under Section 80C of the Income Tax Act. Furthermore, the payout received at the maturity of the policy is also exempt from tax under Section 10(10)(d). On the other hand, savings accounts specifically designed for children's education often provide tax benefits under Section 80E of the Income Tax Act. This section allows for deductions on the interest paid on loans for higher education. These tax incentives, when used wisely, can significantly reduce your tax liability while ensuring your child's future education needs are met. However, it is important to note that while these strategies, including tax deductions and credits, offer valid methods to decrease your tax liability, it's essential to uphold the South Africa Revenue Service regulations. Ensure that all deductions, whether they be business expenses, insurance premiums, home office expenses, are legitimately claimed, complete with thorough documentation backing each claim. Similarly, tax credits, like the foreign tax credit or the retirement savings credit, must be claimed diligently, with evidence and within the limits by the law. Navigating the intricacies of tax laws, with their multiple allowances, deductions, and credits, can be a complex task. Hence, consulting with a tax professional or financial advisor who has a profound understanding of South African tax legislation is always a prudent decision. Having dived into these strategies and incentives, it's time to put them into action. Remember, a journey of 1,000 miles begins with one step, and the same applies to efficient tax planning. Initiate this journey by appraising your current financial situation, identifying areas where there might be potential for tax savings. Perhaps it's time to increase your contributions to your retirement fund, or maybe you haven't been making the most of the tax-free savings account. Coming up, we will be delving deeper in the suite of tax we've introduced in this video with a special focus on Section 12J. This incentive is a government scheme designed to boost economic growth and job creation in South Africa by providing tax benefits to investors who invest in a variety of qualifying small and medium-sized enterprises. It presents a remarkable chance to lessen your tax liability while simultaneously contributing to the growth of our economy. Additionally, the Retirement Annuity Fund and the Small Corporation Incentive should be considered, which are all excellent means to reduce your tax liability. Furthermore, let's not forget about the annual exemption on interest earned. This is a specific amount set by the South African Revenue Service that you can earn in interest during a tax year without having to pay tax on it. It's a fantastic way to make your savings work harder for you. Remember, each little helps when it comes to tax planning. Lastly, don't be shy to consult with a tax professional or financial advisor. The intricate and constantly evolving nature of tax laws necessitates expert advice. These professionals can provide you with customized advice tailored to your unique circumstances and guide you through the labyrinth of tax legislation. Procrastinate. Get your tax planning underway today and have your money work for you. Lastly, let's talk about the Section 12J incentive. This can help you by allowing the full amount of your investment to be deducted from your taxable income. Then we have the Retirement Annuity Fund, a significant incentive where contributions are tax deductible up to a certain limit. Another key incentive is the Small Business Corporation Incentive, offering tax relief to smaller businesses. Lastly, remember to take advantage of the annual exemption on interest earned, another method that can help reduce your tax liability. So there you have it, a roadmap to legally minimizing your tax liability in South Africa. Remember, tax laws change frequently, and it's important to stay up to date or hire a professional accountant to help you navigate these complexities. We at SGBS Group are here to help you understand and utilize the tax available to you. At the end of the day, It's your pie, and you should get to enjoy as much of it as possible. Thank you for watching our series on SGBS Group TV. Don't forget to subscribe for more insights on tax incentives and saving strategies.